Welcome to the Explainer. I am so pumped you're hanging out with us today because we are diving into something that is totally thrilling, but honestly so misunderstood: day trading. Look, whether you're brand new to this or you've been messing around in the markets for a bit, today is going to completely flip how you look at price action. We're pulling all of this directly from Ross Cameron's incredibly detailed guide, How to Day Trade. We're going to break down the actual mechanics, the psychology, and those structured visual patterns that literally separate the pros from the amateurs. But right out of the gate, before we even touch a single strategy, we've got to face a pretty harsh reality. 90%. 90% of day traders fail. They lose their money and they completely wash out of the market. Now, I know that sounds super intimidating, but it immediately sets the stakes for our explainer today. It's exactly why we need to get under the hood and really understand the mechanics of the market, instead of just crossing our fingers and relying on blind luck. So, here is our roadmap for today. First, we'll look at exactly why that massive failure rate exists. Then, we'll talk about developing the risk manager mindset. After that, hunting for volatility. And finally, reading candlestick charts to put the whole puzzle together. Let's shift that mindset from gambling to disciplined pattern recognition. All right, Section 1. Why most traders fail. And hey, spoiler alert here, it actually rarely comes down to your intelligence or just picking the wrong stock. It's almost entirely human psychology. Think about it. The two absolute most destructive habits you can have as a trader are holding your losers way too long and selling your winners way too soon. And guess what? Both of those come from one incredibly powerful emotion: the fear of loss. When a trade starts tanking, an untrained trader panics. They might do something super dangerous like averaging down, which means buying even more shares of that losing stock, just desperately hoping it bounces back. A pro? They just cap the loss and walk away. On the flip side, when that untrained trader sees a tiny profit, that exact same fear makes them panic sell before the stock actually has a chance to really run. And the traps don't stop there. So many traders get caught up constantly bouncing from one indicator to the next, basically hunting for this mythical holy grail strategy that somehow wins 100% of the time. Look, I'll save you some time. It doesn't exist. You might as well be hunting for a unicorn. You add in letting pure impulse guide your choices, trying to revenge trade to aggressively win back money after taking a hit, or entering a trade without deciding your maximum loss beforehand. Yeah, that is a total recipe for disaster. It really goes to show why you absolutely have to train your emotions just as you study the textbook stuff. So what does this all mean? Well, the ultimate goal is perfectly captured by this idea. A day trader is two things: a hunter of volatility and a manager of risk. That right there is the core philosophy. It's what takes us away from the emotional roller coaster of the 90% and straight into the strategic, disciplined world of the top 10%. And that brings us to Section 2, the risk manager mindset. We are officially tossing the emotions out the window and bringing in a strict math-first approach. Gamblers think about profits. Traders think about risk. Seriously, if you only remember one single thing from this entire explainer, make it that. True professionals will add to their winning positions, but they never, ever add to their losers. They're constantly balancing their risk across all their trades. That way, if they make one mistake or the market does something completely unpredictable, it doesn't wipe out their entire account in one swing. Let's actually look at the pure math behind this, because it's fascinating. If you maintain a totally disciplined 2-to-1 profit-loss ratio, which just means you make twice as much on a win as you lose on a loss, you literally only need to be right 33% of the time just to break even. Think about that. If you're right just 50% of the time, you are making fantastic money. You do not need to be perfect. You just need ironclad risk management. A huge part of managing that risk is just understanding the rules of the game you're playing. Take the short sale restriction, or the SSR. Whenever a stock drops 10% in a single day, the market turns this on and restricts short selling. Basically, you can only short when the price is actively ticking up. Why do we care about that? Because it shows us the market literally has built-in safety brakes to stop traders from fueling a flash crash. Inherently, the mechanics of the market have a long bias. It's actually designed to go up. Okay, so now we know how to protect our cash. Let's move to Section 3, hunting for volatility. We are officially on the lookout for major momentum. We only want to trade stocks that have massive retail interest. And usually that's kicked off by a major news catalyst. Stuff like an explosive earnings report, FDA clinical trial results, or even buyout rumors. When you're tracking a stock, you want to see massive relative volume spikes. Big volume is exactly what confirms that thousands of other regular traders are staring at and trading the exact same stock you are. If a stock is just slowly drifting with low volume, day traders won't even touch it, because without volume, there's just no predictable momentum. But volume alone isn't enough. It has to be paired with this crucial concept, the float. The float is simply the number of outstanding shares that are actually available to trade on the open market. And why is this a big deal? Supply and demand. We are looking for extremely high demand from a news catalyst paired with very low supply. Specifically, day traders are hunting for momentum stocks with a float of under 50 million shares. When you get that perfect storm of extreme demand and incredibly low supply, the result is completely explosive. Combine a low float stock with massive news, and you get what's called a full float rotation. That means literally every single available share is changing hands multiple times in one single day. This specific setup is exactly what fuels those massive, crazy 100 to 200% intraday gains that day traders are always looking for. Now, once a stock actually makes a huge move like that, we don't just ignore it. We watch it super closely over the next couple of days. We're looking for what we call follow-through days. This happens when momentum just keeps rolling and a new price candle physically breaks above the previous day's high, instantly bringing in a fresh wave of buyers. On the flip side, we have an inside day. That's when the stock just lazily trades within the exact same range as the day before. An inside day is basically the chart screaming at you to just stay on the sidelines because the fresh momentum is gone. Which brings us to the final piece of the entire puzzle. Section 4, reading candlestick charts. Let's talk about how to visualize all this data so we can time our entries and exits completely objectively. To do this without any emotion, traders rely on 1 minute, 5 minute, and daily increments. So let's break down the anatomy of a candlestick. Every single candle gives you 4 specific data points for that chunk of time: the opening price, the closing price, the highest price, and the lowest price. The thick, colored part in the middle, that's the real body, and it shows you the difference between the open and the close. And those little thin lines sticking out of the top and bottom are the shadows or wicks. Put it all together, and it gives you a perfect visual story of exactly what the market sentiment was in that specific moment. Let's see how you actually apply that out in the wild. Take a formation called the doji candle. A doji has an incredibly small, almost flat real body, and that tells you one thing: indecision. It means the stock opened, the buyers aggressively pushed it up, the sellers aggressively pushed it down, but by the end of it, the stock closed right back exactly where it started. It's a total standoff. If you spot a doji right after a massive run-up, you've got to pay attention because it very often marks a major reversal right at the absolute top of a trend. Now let's compare 2 other really critical signals. First, you have bottoming tails. These have long, stretched-out lower wicks, which tells you that sellers tried really hard to crash the stock, but buyers stepped in, hammered out a brand new base, and drove the price right back up. It is a classic reversal signal. Contrast that with long body candles. These show extreme, totally uninterrupted momentum, either incredibly bullish or bearish. During a long green body candle, the pros are holding their positions to maximize their profits. But here's the kicker: they never ever chase the stock by buying in at the very top of that long candle. And that brings us to the absolute biggest question of the day. Are you ready to actually manage the risk? As we've seen throughout this explainer, successful day trading is not a casino. It's a highly structured system. It takes unwavering emotional discipline, a sharp eye for highly specific volume, and totally objective risk management. The 90%? They let fear and greed run the entire show. So the real question is, are you ready to do the math and become the 10%?